Let's talk a little bit about the Canadian dollar. Its performance as of late has been weak, especially when we compare it to the US dollar, our neighbor to the south, and our biggest trading partner. With that being said, let's get a general understanding of how exchange rates move. This way we can get an understanding of how we got to where we're at today and where we could potentially go in the future. We'll finish it off by one of the things I've been thinking about, a theory that I have that could potentially lead the Bank of Canada to move higher with the interest rates. So stay tuned for that. If this is your first time here, my name's Nick and welcome to Ways to Wealth. As I mentioned in the intro, today's topic is all about the Canadian dollar. And it has definitely shown weakness not only to the US dollar, but also several other currencies throughout the world. But because the US is our biggest trading partner and will have the biggest impact on our economy, that is where we're going to focus on today. But first, we're going to get a better understanding about how this exchange rate moves. And there's no better place to start than looking at the Bank of Canada. And they published this article called Understanding the Exchange Rate. So we'll go on to read that the Bank of Canada actually doesn't try to set the dollar's exchange rate. They let the markets do that. And because they let it float, we can focus on setting interest rates to maintain inflation at 2% in Canada. And we know that they are off the mark, and that is definitely their focus. If you've seen any of my other Bank of Canada videos, this is definitely well known. Demand for our dollar is affected mainly by demand for Canadian goods and services, and the more that people want to buy what we sell, the more the Canadian dollar is worth. And when we talk about the upcoming recession fears, this is definitely a concern, but the strength of our economy relative to other countries also affects the dollar's value. Some specific factors that make it go up is our interest rates relative to other countries. So as I mentioned, we'll talk a little bit about what's happening in the US, more from a perspective of what the Federal Reserve is doing and what the Bank of Canada is doing. We'll start out by talking a little bit about what's happening in the US. Overall, the economy is fairly healthy. Their latest GDP report came in at something like 5%, which shows that there's still robustness, although they have been impacted by higher interest rates and higher inflation. We heard from Jerome Powell this week. We'll read a little bit about what he said behind the messaging towards interest rates. And we can see here that we know that ongoing progress towards our 2% goal is not assured. Inflation has given us a few head fakes. If it becomes more appropriate to tighten policy further, we will not hesitate to do so. So currently, the interest rate is sitting at 5.25%, and the overall economy is still running hot, which means inflation could run hot. And that means overall that things are looking relatively well for holding the US dollar. Now, on the Canadian side, we read a little bit of similar messaging we also heard from Tiff Macklem lately, and we can read here the council members agreed to revisit the need for a rate hike at future decisions with the benefit of more data, and they agreed to state clearly that they were prepared to raise rates if required. Now, it's almost the same verbiage that we heard from Jerome, but there's a different situation happening here in Canada in the sense that we are 1 quarter away from a technical recession. That means 2 recessions in a row with negative GDP growth, and our interest rate is sitting at 5%. So if we're already in a state where we could potentially be cutting interest rates, which a lot of economists are predicting right now, especially as early as next year, this is a situation where the US dollar is becoming more strong. You want to own US dollars in this type of environment. Now, the second factor when considering what moves exchange rates is the inflation rate. Now, I know we touched on it a little bit, and they have been high in both countries, but have been persistent or pesky and not returning to that 2% target. So I think we're both in a similar situation. The backstop really becomes how the economies are performing with that inflation, and we already touched on how the US is outperforming us. But what I really wanted to talk about is what consumers are expecting inflation to be. Now, the data that we're going to take a look at right now is a little bit outdated, but the overall perception is basically the point that I'm trying to get across. And if we take a look at this chart, its elevated perceptions of current inflation are leading to persistently higher near-term inflation expectations. Now, what the heck does this mean? It basically means that if the consumer thinks that inflation is going to stay high, they are more likely to make purchases today because they're fearful that they'll have to pay more for the same product a year down the road. It's a situation where people are willing to buy stuff today because they think the price is going up tomorrow. And what that does is it actually adds on to inflation because you still have that demand in the economy. You still have people going and purchasing things. Now, realistically, when we draw that back, retail sales, many other different sales in Canada have fallen off. In the US, those numbers are still producing relatively well. So they may actually have inflation for a lot longer, but that just means that the economy is still running hot. And again, that's why both banks and Federal Reserve are looking at curbing that inflation, and they're looking to do that with higher interest rates. I just don't think that the Bank of Canada really has that firepower, the same firepower that Jerome Powell has south of the border. And the third point that's mentioned here is the demand for financial assets like stocks and bonds. If the economy is not doing well, the Canadian companies, the publicly traded companies, are not going to perform well. So I couldn't imagine that this is going to be an area that people are looking to invest their money, and not an area I'm really going to focus on. What I really want to focus on is where our currency could potentially go in the future. And what I'm looking at right now, the biggest perspective is what we import. We are an importing nation. I believe it's something like 70% of the goods we consume have been imported. And we're going to learn a little bit about how that affects us. What we're looking at on the screen here is the trade data between Canada and the US. We definitely send a lot of goods down south, but we also import a lot as well. So we take a look at the latest 2022 numbers, and we can see the darker line is the imports, the lighter line is the exports. And the fact of the matter is that we have definitely increased the amount of goods we have been buying from the US. Call it the supply chain shock when you couldn't buy things from overseas. They were all ruined. A lot of suppliers, a lot of companies here probably looked to the US because it was easier to get those goods. Now, there has been a significant increase from 2021 to 2022 from $630 million to all the way to $757 million. But realistically, what the overall problem here is that we are buying these goods with Canadian dollars, and they are probably being sold to us in US dollars. So if our currency depreciates, then we're actually paying more for those goods, and it actually could hurt our inflation rate because of the fact that they are our latest trading partner. So let's go on to read a little bit more about this impact. So we'll jump over here to Statistics Canada, and they've actually done a good job of breaking down this actual scenario. So various factors may have an impact on our import prices. One of these factors is the exchange rate, especially the Canada-US exchange rate, as the US is the main source of imports. And chart 3 shows the quarterly import price index and the Canadian-US exchange rate from the first quarter of 2018 to the fourth quarter of 2022. As shown, there seemed to be a little pass-through effect of the Canada-US exchange rate in Canada's import prices before the current high import inflation started in the second quarter of 2021. After the second quarter, the Canadian dollar depreciated by 10.6% against the US dollar, and import prices increased by 19.4%. This co-movement of import prices and the Canadian-US exchange rate after the second quarter may suggest a pass-through effect of depreciation of the Canadian dollar on import prices. So definitely a huge impact, not only to businesses here, but to the consumers who have to pay the higher prices for these companies to import those goods. If you're interested in reading this article further, I will throw it down in the description, but we're going to jump here to the conclusion. And the evidence in this article shows that import prices played an important role in increasing inflation in Canada because of the country's reliance on imported goods and services. As a trading nation, Canada imports a large share of the goods it consumes, including energy, consumer products, raw materials, capital equipment. Therefore, a rise in the prices can significantly reduce the purchasing power of consumers and raise production costs and hence output prices. Given the importance of the rise of import prices, the monitoring of import prices and global coordination on inflation control become essential for maintaining price stability and supporting the overall health of the Canadian economy. Now, again, this goes to my point is that if the Canadian dollar continues to fall off today, we will see more inflation for the goods that we consume. We've been doing a pretty good job of getting inflation under control, but this is definitely a concern moving forward. So when I look at it overall, the Canadian economy is not doing so hot. There is a chance that the interest rates could come down. There is a chance that we fall into a recession. The US dollar is definitely looking like it is going to appreciate over the next 6 to 12 months, if not longer. And if that does happen, we could end up in a situation where the Bank of Canada has to show that stability, potentially raise the interest rate, although we are being impacted, to save our currency from further deterioration for the amount of goods that we import. So there's a lot of a double-edged sword right now happening for the Bank of Canada. We want to make sure that the inflation rate goes down. It's killing the Canadian dollar in the interim, but if we kill the Canadian dollar, then we're going to see persistent inflation because we import goods with US dollars. And if our currency can't go as far, then we're kind of stuck in a middle ground and in a world of pain, to say the least. So I definitely am not bullish on the Canadian dollar moving forward, and we're definitely in a pickle. Luck to Tiff. Hopefully we can scave it. But in this current situation, it's not looking pretty. Make sure to let me know what your thoughts are about what's happening with the Canadian dollar. Are you bullish? Are you bearish in this current market? If you're playing a trade in any certain way, let me know down below. I'd love to see what you guys are doing in the market. But if you like content like this, we cover the Canadian dollar and the Bank of Canada. So I'll link some videos right here that you can check out. I appreciate you watching. I hope you all have a great week in the markets. Happy investing.